Welcome to the Nichols Tax Update Podcast. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I acknowledge the value of my subscription to Tax Notes Today, the preeminent source of information for tax professionals and my primary source of authority in preparation of this program. So let's get started. What's here? An item reminding us that tax debt may not be discharged in bankruptcy. Income earned in Afghanistan was not excludable under old law, and that's important to know the version of law that's applicable to a case when you're reading the decision. A Greenspace developer was denied 501c3 status. Had all the right moves, just couldn't quite get it done. COVID-19 testing under Medicaid is not minimum essential coverage, which will cause the recipient to lose the benefits of the premium tax credit. The IRS acceptance of a return is not necessary to start the running of the statute of limitations. Then a funeral service organization was not entitled to 501c3 status, and we'll see if you agree with me that it probably never should have been granted 501c3 status. 6. Frequently asked questions from marijuana industry participants should be helpful. The IRS is seeking comments on a new form, a Section 754 election revocation form. We'll talk a little bit about what I think that means. Then we have a practice unit, which contains audit tips for Section 911 exclusions. That's the exclusion for income earned in a foreign country. And that's subject to some special rules. We've talked about these practice units before. The IRS is turning them out at the rate of 2 or 3 a month, and they're really helpful. Anyway, let's move on. In Feshbach versus the Department of the Treasury, the 11th Circuit Court of Appeals, one of the points that we are reminded of here is from this taxpayer's disaster, is that there can be no partial discharge of an income tax debt in bankruptcy. It's all or nothing. Either it's all discharged or it's not. The statute of limitations is important here. Mr. Feshbach was a successful financial advisor in the 1980s and the early 1990s. The market turned against him and his particular style of investing, and he wound up owing income tax of almost $2 million in 1999. He made no payments, but he did file a return. That was the beginning of a long saga of doing better, not paying the tax they owed, trying to get the IRS to agree to offering compromise settlements, making some payments, not making some payments, and by the end of 2001, a little over a decade later, their tax debt was $5 million, and when the recession hit in 2008, it was game over, and the Feshbachs filed for bankruptcy. Even though the statute could have run on some of their old tax debt, it did not, due to Feshbach's multiple manipulations of the system. Proposing an offer in compromise, making a few payments, then stopping the payments, proposing another offer, not completely filling out their financial disclosures. Several offers were in fact accepted. The IRS employees tried to work with them, and they'd make payments for a few months, but their situation got worse and worse and worse. When they filed for bankruptcy in 2011, after the financial meltdown in 2008 and 9, the taxpayers expected to be shielded from some parts of their tax debt because some parts of it were arguably over 10 years old. They went all the way back to 1999. There was no relief here for 2 reasons. One, the court determined the liability could have been paid, but for the taxpayers' manipulation of the system. They had the money. They made a lot of money. They made several $1 million a year for some period of time. During the time they were manipulating the IRS, and finally, bankruptcy courts do not allow partial discharge of income tax liabilities. You can put that in your pipe and smoke it. No, don't say smoke. Not here. Income earned in Afghanistan is not excludable. Now that's old law. I want to remember that as we talk about the Haskins decision. This decision and its reporting teaches a couple of things about the tax law and court decisions on the law. First, words and their meaning are important. Code Section 911 allows a foreign earned income exclusion when a taxpayer meets the requirements, one of which is to have an abode in a foreign country. We got to get what is the definition of an abode. The second requirement is they got to be physically present in that country for 330 out of 365 consecutive days. Now, what does that word abode mean? It means more than just your tax home. We know from these programs that your tax home is where your job is. So an abode means more than just your tax home. It means all the trappings of living in a community. Ms. Haskins lived in a military compound in Afghanistan, and before 2018, that could not have been her abode. The return at issue here, however, was for 2012. The litigation is going on in 2020. So we need to go all the way back to the law that was in force in 2012. And in 2012, she could not establish an abode living on a military base. After 2017, which is probably all you care about, frankly, the abode requirement is waived for a taxpayer that lives on a military base. COVID-19 testing under Medicaid is not minimum essential coverage. Notice 2020-66 tells us that. If you have minimum essential coverage under a government-sponsored program to provide your health care, you do not qualify for the premium tax credit. To qualify for the premium tax credit, you must be purchasing your health care coverage from a government exchange. This notice assures lower income persons, typically those who qualify for the premium tax credit, who get free COVID-19 testing and diagnostic service, that they will not lose their premium tax credit for any month they receive a COVID-19 benefit. That's helpful. We want everyone to be tested and to get the any treatment that they need to reduce the spread of the virus. Now, the IRS acceptance of a return is not necessary to start the running of the statute. This is Robin J. Fowler, 155 TC number 7. The tax law, folks, is full of complexities, and this is one of them. Statutes of limitation set deadlines for benefiting from a tax refund claim, having protection from an audit, or making certain adjustments in previously filed information. The statute of limitations here started with filing a return. The IRS sent it back on a technicality, but that did not give more time to audit the return. The IRS tried to start an audit more than 3 years after the return was originally filed. The tax court said the taxpayer had the benefit of the 3-year statute. The IRS could not start an audit. They could not extend the statute by the trick of sending a return back for a minor clerical error. I thought this was a great decision. The IRS should always be held to the rules, although they will try to not abide by the rules if it's to their advantage. Don't ever think they won't. Now, here's a funeral service organization which is not entitled to 501c3 status. This is the Korean American Senior Mutual Association, Inc. The name should have been a dead giveaway. Oh no, pardon the pun. Although initially approved and operating for several years, when this organization was examined, the IRS discovered large sums used to acquire real property, and in this case an office condominium that they really had no need for, grants used to pay travel expenses of Koreans to travel to Korea. It was not at all clear that the organization served a charitable class. All citizens over 65 could be a charitable class. All Koreans over 65 could not, at least according to the Internal Revenue Service. The exempt status was revoked and the revocation upheld on this appeal. This organization appealed its revocation to the tax court. It was not going to go away quietly. 6 FAQs for marijuana industry participants. 6 very practical questions and answers on the most pressing issues facing those who are seeking to profit legally from trade in a controlled substance. I'm in the legal business of selling marijuana in my state, but it's illegal in the United States. This has got to be a little bit confusing, and it is, in fact. Some CPAs want nothing to do with the marijuana industry for fear that they will somehow be caught up in a push-me-pull-you between the state law and the federal law. Others are learning what they can to serve clients in this highly profitable industry. The question is, does tax law apply to marijuana business the same way it applies to other enterprises? And the answer is yes. Payroll taxes? Yes. IRS audits? Yes. Cash payment reporting? Yes. Penalties? Yes. Deductions? No, not so much. Code section 280E disallows all deductions for any amount paid in connection with trafficking in a controlled substance. You may, however, reduce your gross income for the cost of goods sold, but that's the only amount that you get to deduct. The IRS is seeking comments on a Section 754 election revocation form. This caught my eye because I never heard of such a thing. Who revokes a Section 754 election? Well, it turns out you can, although I've never encountered it in over 40 years. We make 754 elections. We ask for the IRS's patience. When we file a 754 election late, we want permission to file it late, but I've never sought to revoke one. On the other hand, I've not had a change in ownership of a partnership since the Tax Cuts and Jobs Act was passed. This new form, 15254, is the subject of a request for comments published in the Federal Register on September the 10th. And the headline obviously caught my eye because it was, who revokes the 754 election? The abstract says that revocation requests have increased since technical terminations were repealed by the Tax Cuts and Jobs Act for tax years beginning after 2017. Now, a technical termination occurred when there was a change in ownership of 50% or more of capital and profits of a partnership. A 754 election requires an adjustment to the carrying value of assets to fair market value when there is a change in ownership of a partnership. So a partnership, if I have this figured out correctly, and if I don't, someone's going to write me or call me and tell me I don't. You could be compelled by an old Section 754 election to adjust the basis of assets following a change in ownership when that's not what you really wanted to do. Finally, this week, we have a practice unit which contains audit tips for a Section 911 exclusion. Now, we talk about these practice units periodically on this program because they are training programs designed and produced by the Internal Revenue Service, generally very technically correct, on point, very thorough, and they're produced as PowerPoint slides. When certain conditions are met, the U.S. tax law permits an individual to exclude some income which is earned for providing personal services in a foreign country from their U.S. taxable income. The amount that can be excluded in 2020 is more than $107,000. The conditions for this exclusion are absolute. You either meet them or you don't, and it's based on facts. Perfect atmosphere for an audit, right? And sure enough, that's where the IRS auditors come in, and this practice unit, a 30-page slideshow, is used to train them. If it can be used to train IRS auditors, it can also be used to train your staff or yourself or to inform your clients. Sit a client that's thinking about working overseas, sit them down, and get them to take 30 minutes and watch the IRS slideshow that explains how the foreign earned income exclusion works. Not a bad idea. Well, there's the old calendar in the hourglass. Until next week, it's me reminding you, please stay safe.